Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the stocks that I think is really intriguing in 2023 is Asana. Now, this is one of the companies that has been losing money in the SaaS market for years. Very high growth company, but a lot of investors criticize it because it wasn't able to turn a profit. Well, that has actually changed. The company is now free cash flow positive and moving closer and closer to being operating income and net income positive. The reason that they're not operating or net income positive is because they do pay a lot of stock-based compensation to employees. So that's a big flaw. I want to get that out of the way right away. But one thing that I can't get over is the fact that CEO and founder Dustin Moskovitz continues to buy back stock week after week. I want to go through his latest buys and then discuss a little bit about the trends of the company, especially ahead of third quarter earnings, which we're expecting in the next few weeks. Because if this is a company that continues to grow revenue, improve that operating leverage, so basically grow your costs slower than you're growing revenue, we could see this be a fairly profitable company within a couple of years. And with a CEO that is backing the truck up to buy back more stock, I think there's a lot of positives for this company. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. I'm going to start quickly with a stock chart view because this is good context for Asana. This is the absolute roller coaster ride the stock has gone on. You can see that it was $26 a share in October 2022 a share. We were as high as over $140 per share for this stock. But in the last 52 weeks, we've seen a low of $11.32. So just a crazy wild ride for Asana stock. And right now we have a market cap for the company of about $4 billion. But as I mentioned, one of the things that I keep coming back to is the fact that Dustin Moskovitz continues to buy back stock. I'm going to go through the latest buys, and these are weekly reports that he's putting out. At this point, bought stock between $18 and $19.71 per share, October 16th and 17th. And this isn't a small amount. This is about $5 million worth of stock. So gets to the point where when insiders are buying, you should be paying attention because there's a lot of reasons for insiders to sell. There's only one reason for insiders to buy, especially Moskovitz. And that's that he's very bullish on the company's future. Let's go back to October 12th and 13th. You can see a similar size lot that he bought, about 350,000 shares of stock. And then here is October 10th and 11th, about 283,000 shares of stock were acquired right around $18 per share. And the last one I'll go through, October 3rd and 4th, over 1 million shares, all bought under $18 per share. So this may be one of the reasons that the stock is up recently is because Moskovitz has been buying pretty aggressively. But the other thing that's really interesting about this is that Moskovitz doesn't seem to be ready or willing to buy all of the company. It looks like he wants to keep this as a publicly traded company. He agreed earlier this year to not acquire over 90% of the company's stock. He also agreed to independent directors. So one of the things that will often happen if somebody controls most of the shares is they can also control the board of directors and kind of do whatever they want with the company. There is going to be an independent board of directors. At least they will have the majority of the voting power. So actually Moskovitz himself could be voted out as CEO by the board of directors. So buying back a lot of stock, but doesn't appear to be wanting to buy the entire company and just take it private. So really interesting moves that I think all mesh together to make this a much more intriguing company for investors. The other thing I wanted to go through is just a couple of financials, because this is something that we're going to be focusing on when results are released, probably in early November. Is Asana continues to grow. Now the growth is slowing a little bit in the most recent quarters, but this is a growth company. We're also seeing them move upstream. This is one of the distribution strategies that companies always have to think about is, are you going to start with small customers and small teams and then try to move up and grow into an organization? Or are you going to start with those big customers, enterprise customers? Well, Asana has started small and then moved up the stack. And you can see that the number of customers spending over $5,000 per year is now about 21,000. And the number of customers spending over $100,000 per year, now 553, up 20% year over year. So that's the way that they're growing the business, is growing the revenue per user a little bit. They talked a lot about AI on a recent investor day. and how that could potentially add value, increase revenue per user that they could charge, and then also increasing the number of customers that they're serving. So spreading out where that operating expense is going. And I always like showing this chart. Asana has just incredible gross margins, about 90% consistently. It will be interesting in the next few quarters as they roll out some of these artificial intelligence tools. That's a very expensive tool to be using in the cloud. So does that start to eat into their margins a little bit? I think that would be okay if it does grow revenue, but something to definitely keep an eye on. Now, the challenge for a lot of these SaaS companies right now is how are you going to get out of a hole of burning money like they have been doing for years up until the last couple of years or last couple of quarters even. During the pandemic, it seemed like these stocks were going to continue going up and they were just going to be able to sell shares if they needed to raise money. But that's obviously not the case, as a stock like Asana has gone from about $180 per share now to about $20 per share. Much harder to raise cash in that way. So you need to transition to being free cash flow positive. Now, Asana has actually done that. You can see from this chart in the most recent quarter that they are free cash flow positive. Not net income positive, not even operating income positive, but they are generating cash flow. So that's really the first step. Now, what you want to see in the future is going to be, can they continue to raise that revenue while cutting operating expenses? We know that Asana has gone through some cost cuts and layoffs. That's something that has happened across Silicon Valley. So that should help lower operating costs. So that's where you get that operating leverage. If you can grow revenue at that 90% gross margin and grow and keep operating costs flat or even down a little bit, that's how you get to free cash flow positive. And they can potentially make that change very quickly. With that in mind, that's why I'm so interested in Moskovitz buying back as much stock as he's buying, especially right now, because he's seeing what they're building and what they're seeing from customers over the next few years. So if he's seeing growth in the business and is more bullish on the company now, and that's why he's buying back stock, then that tells me that there's something there that investors should be looking at. So a couple of things that I'm going to be looking at when the next quarterly results are released. What do those operating expenses look like? Not only the overall operating expenses, which includes stock-based compensation, but also those cash operating expenses. So kind of think about those in two different buckets. Stock-based compensation is going to be your dilution as a shareholder, definitely something to think about. But if their cash expenses are declining, then that means the company's odds of survival and their ability to thrive in the future by not having to raise money actually gets better. So that's what I'm looking at from an operating side. From a revenue and margin side, is this a company that's still growing? If they can grow in an environment where companies are starting to cut back costs, I think that would be extremely bullish. And remember, you want to see the top of that funnel being filled with customers who are paying less than $5,000 a year. You can get a seat even for free. You can start using Asana. But once you start adding those tools, it's about $10 or $12 a month per user to start paying for Asana. And so you can actually grow pretty quickly within an organization or even with a small business at a price point like that. And then that's, like I said, that's the top of the funnel. And then you start to move up in organizations and get to those bigger and bigger customers, even grow with some of your customers. So this is a long-term growth play. I think the margins are phenomenal. The way that they're building their business to interact together and even use artificial intelligence to power the tools and empower leaders who are making decisions for organizations. That is just a phenomenal business model. Now it's going to be a question of, can they turn that great business model and the software behind it into a good financial business? They have not done that yet. But the reason that I'm intrigued is that it seems like they're moving in the right direction. And if they're moving in the right direction and the CEO and founder are buying back stock, then this is definitely a company that should be on your radar. But what do you think of Asana right now? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.